the panel discussion as part of the American Finance Association on capital constraints, public policy, and minority entrepreneurship. And we are delighted that all of you saw fit to get up at an ungodly early hour and make it through the cold to get here. We have a great topic, an important topic, and a complicated topic to deal with. I think, this is an area where it's clear there hasn't been nearly as much research as there could be or should be around these issues. And I think one of my real goals in terms of organizing this session was to try to get people excited around doing work in this, doing work and thinking about these issues. And we're very fortunate to have a group with us who spans academic thinking around questions of minority entrepreneurship and financing, practical experience, and policy experience, which I think will make for a provocative and interesting set of discussions. I think it's worth highlighting that, as is often the case in terms of conversations about entrepreneurship, a lot of stuff fits under the entrepreneurship bucket. In a way, you can think about, often we make this distinction between Main Street and Silicon Valley, the sort of ma and pa, pizza shops, barber shops, or whatever on the one hand, which are, the sort of, very large in number but relatively limited in growth prospects, and contrast that with the Facebooks and other, sort of, high growth, high visibility, kinds of startup ventures. But clearly there's also a third range of companies in the middle as well, which are often, serving in, various B2B subcontracting kind of roles, whether it's tool and die, IT services, and so forth, which may not have quite the, the glamour of the Snapchat or Facebook, but have, again, a sort of real potential to be job creators. So there's a lot of stuff going on here and a lot of complexities, and we're probably not going to do justice to them in the next 113 minutes, but we'll take our best stab at doing this. What we're going to do for today is really a sort of short introductory thing where each of the panelists is going to say a few things, mostly about themselves in their background and perspectives, with one exception. And then I've put together a few questions that I'd like them to take a shot in terms of looking at. The one exception in terms of the introductions is Rob Fairlie to my immediate right, who has got actually a few slides with data on it. And I thought that, in particular, some of Rob's data might be helpful in terms of teeing up some of the issues that we'll dive into in terms of just giving a flavor of what the nature of the problem and the issues really are. So with that, I will turn the floor over to Rob. I'm going to ask each of the panelists to introduce themselves as part of their opening remarks, and then we'll get into the substance of it, and we'll finally have some time for Q&A afterwards. So, Rob, the floor is yours.
Great. Okay, so just to get started out, basically I'm just going to give you some background. So, as Josh introduced me, I'm Rob Fairlie. I'm a professor at University of California, Santa Cruz, also a visiting scholar at Stanford, and a research associate in the MBR. I've been doing research on this topic for many, many years. I won't say how many, because I don't want to date myself. But it's interesting because there really has been kind of a lack of research on the topic, which is quite surprising, because if you look at, just to kind of give you some background on it, earnings inequality among different racial groups. So if you compare African American to white levels of earnings, right? This is just kind of common data from the Bureau of Labor Statistics. It's 77%, right? And there's been a huge amount of research that's documented why that's the case, how it's changed over time, how earnings inequality has changed with different types of jobs and with different programs that the federal government has created. And then you can also see Latino earnings are about 72% of what white levels of earnings are. There's a huge amount of research in economics. There's a paper, the handbook chapter that came out by Joe Altanji and Becky Blank, that has literally thousands of citations if you go on Google Scholar. Now, once you switch over to business ownership and look at the inequality there, what you see is it's much more extensive, right? So business ownership rates, just starting out in general, African American rates are about 40% of what white rates are, and you can see that Latino rates are about 75%. And this is just the percent of people that own a business. Then if you look at sales among those individuals who start businesses, you see even more inequality. Okay, so if you look at the average sales for white-owned businesses, they're over $500,000 per year, but then you look at African American-owned businesses, and they're 11% of that total. Okay. Then if we go to job creation of these businesses, you also see a lot of inequality there, that African American businesses are creating about 16% of the average number of jobs as white-owned businesses, and you can see that Latino-owned businesses are creating about 28% of the jobs that white-owned businesses are. Now, what are some of the causes of this? That's what we're going to discuss in the panel, so I'm only going to briefly show you some of the data on this. If you look at wealth inequality, it's shockingly high. The median net worth of white families in the U.S. is over $100,000. The median net worth of African American families is $6,000. So half of all black families in the U.S. have less than $6,000 in terms of wealth. And for Latino families, it's pretty similar. You see about $7,000 or $8,000 is all. And so those differences you can see are just quite striking. And I've had some new research, and this is much harder to get the data on access to capital and use of financial capital among black-owned and white-owned businesses. And you also see a high level of inequality there, that black-owned businesses are using 33% of the amount of capital at startup as white-owned firms, and about 40% in the subsequent years. Now, what's important here is that these data are conditioning on successful businesses. These are not the mom and pops that Josh mentioned earlier. These are actually businesses that are intending to grow, that are intending to hire employees, and you still see those levels of inequality. If we looked at all the mom and pops and the bigger universe of all businesses, we'd see even more inequality here. It's just much harder to get that data. Okay, so those are the introductory remarks that I wanted to do. And I guess we'll turn it over to the next panel.
Yeah. Stuart, thanks so much, Rob.
Wow, thank you. Good morning. My name is Stuart Taylor. I represent a firm called the Taylor Group. Just a word on my background. I spent the vast majority of my career in investment banking on Wall Street. Spent 19 years doing corporate finance and mergers and acquisitions, mostly at Morgan Stanley, but moved to a few other firms and finished up with Bear Stearns. In 2001, I wanted to go out on my own and become more of a principal rather than an advisor, and that's when I formed the Taylor Group. I like to refer to us as a non-traditional private equity firm, non-traditional in the sense that we don't use institutional capital. Our capital comes from my own capital, high net worth individuals, and a few family offices. And we look to build, in short, build minority and support minority entrepreneurs. All of our companies in our portfolio are that we've invested in or acquired are run by minorities and or women. So we take a different approach to our hold period. We look at exits and return of capital differently, mostly because of the fact that our capital comes from non-traditional sources. So this is a topic that's near and dear to my heart. I've also worked a lot with the certification sector, so companies that are looking to do business with supply firms in their supply chain that are owned by minorities will often require that those companies become certified, which has created a whole sort of cottage industry unto itself, and I've been an advisor and consultant in that space as well. So nibbled around the edges of this topic, and I'm very happy to be here with everyone this morning. Thank you.
Great. Thanks, Karen.
Good morning. Good morning. I'm delighted to be here. I am currently a senior fellow at Harvard Business School with Josh in the entrepreneurship area. But for 25 years, I was a venture capitalist. The work that I'm doing now at Harvard is really focused on access to capital and with particular views on the fintech explosion and how that may or may not be affecting small business and their ability to borrow in the small dollar area, which is where the credit gap is. And a second area of research is in the supply chain and how the supply chain is creating jobs, particularly small suppliers. But of particular interest in this panel is that in between these my time as a venture capitalist and this, I spent 5 years working for President Obama as the head of the SBA. And in that period, I was fortunate to be in the president's cabinet and part of his White House economic team and responsible for revitalizing small business from 2009 to 2013. And that was, of course, the Great Recession. So my strong views on a couple topics that we're going to talk about today come from being really in the line of fire in those years, and putting forth the proposal in the White House economic discussions that small business was critical to the recovery. And as you all know, it was a credit crisis, and in a credit crisis, those firms that are credit dependent suffer the worst. So of course, small business was absolutely crushed. And one of the things that I think we kept front and center is that we really needed our entrepreneurs in order to drive our economy. And that included our Main Street entrepreneurs as well as our high growth entrepreneurs, and that each of them required different kinds of capital, particularly in order to grow and create jobs, and that job growth was critical to the economy. Now, economists really don't universally buy into this theory. And in all of the colleagues that you might hear today, there really isn't sort of a macroeconomic view that comes in and validates this proposal that I've put forth that small business is really essential to the economy. And maybe many people say, well, it's not really important, you know, small businesses churn, they aren't really going to grow, and then there's this small segment. But there's not actually a great set of views about the impact of entrepreneurship on small business, much less the impact of a more inclusive set of access and opportunity to minority-owned businesses or women-owned businesses or other underserved markets. But we do know today from some work that Houghton-Wanger and others have put forward that the rate of entrepreneurship is going down. So the sense of urgency and the sense of worry is kind of coming to the front in this field, and I would urge and hope that there be more work in that area. The second area where I have a strong view, and perhaps there's not universal agreement in the ranks of economists, is that I believe that government has a role in helping access and opportunity in this sector to the underserved markets. The argument against is that you are putting your thumb on the scale and that this interferes with the way markets are working. And I think my argument back, or I know my argument back because I had the great opportunity to testify to Rand Paul, who was cross-examining me on this particular point, is that there are market failures. And how do we know that there are market failures? So one example is the SBA has a portfolio of $100 billion of loan guarantees. Those loan guarantees are supposed to be for loans where the bank would not make the loan without some help. So we know that the market really wouldn't make this loan. It's extra trouble and fees to make an SBA loan, so you wouldn't choose automatically to get an SBA guarantee. And the default rate on these loans is less than 5%. So these are good loans that really should be made because they help businesses be more successful, but the market wouldn't make them. And not surprisingly, the portfolio is disproportionately filled with minority-owned businesses, underserved businesses, women-owned businesses. So that's sort of just one broad place that we observe. that the market is not operating, that certain people who can run a successful business are having trouble getting access to capital. I think that if we can find the way to get more insights, get more research, get more data in these areas, we will be able to benefit our economic growth.
Okay, thanks, Ken. Yeah.
Hi, my name is Euler Bropleh, and I'm honored to be here and part of a very distinguished panel. I'm obviously the youngest one on the panel, and the viewpoint I bring
Rub it in.
is more from an entrepreneurial standpoint. I run a company called VestedWorld that I started 2 years ago, and our focus is investing in early stage businesses based in emerging markets. Right now we focus exclusively on countries in sub-Saharan Africa. By background, I'm from Liberia, hence my interest in emerging markets. I practiced law for a number of years, focusing on private equity, venture capital, and traditional corporate transactions. And started VestedWorld really, in part what Karen was saying about the importance of small and medium-sized businesses. I looked at countries, particularly in sub-Saharan Africa, saw that there was a lack of capital flowing into early stage, small and medium-sized businesses that had the ability to scale and provide jobs and pay people fair wages. And when you look at how countries have developed over time, I mean, even the US, Western European countries, and particularly more recently, the Asian tigers, countries follow a very similar path to being a developed world country. They develop their agricultural sector, develop manufacturing sector, and then the service technology-based economy kicks up. And for the most part, even though small and medium-sized businesses around the world employ anywhere from 60 to 85% of the population of any country, you just don't see the same type of capital flowing into those businesses. And as I started to think about why that may be, thought that there was a need for a more innovative solution to financing companies in those regions. And that's why I started VestedWorld. And for the purposes of this panel, I think the perspective I'm going to provide is more from an entrepreneur standpoint, what the process has been like over the last 2.5 years raising capital for our business, the challenges we face, the opportunities we see. So excited to kick things off.
That sounds great. Well, I mean, maybe the place to really start is trying to say what lies behind the numbers that Rob had shared to start off with. In other words, when you look at the kind of disparities in terms of business starts and the size of the businesses that are started, it is really pretty striking. And how do you, I mean, it seems that you could point to a bunch of different things as potentially behind this. What stands out as being the key drivers of those kinds of disparities? Because it seems before we can get to how can public policy or corporate procurement or whatever address these things, we need to understand a little bit more of what's at the root of these issues. So I'd be interested in people's thoughts there. Do you want to start?
So I think there are the obvious reasons that everybody talks about, and Rob talked a little bit about some of these in the numbers he was showing. So the wealth inequality is an obvious example. When you have a segment of the population that doesn't have as much wealth, inherent wealth, where they can take the types of risks that entrepreneurship requires, that's obviously going to lead to less people from those particular minority groups starting businesses and really trying to grow them. The access to capital and availability of risk capital from within their own socioeconomic group plays a role. So as an African American, you would think if I went out to raise money from investors, African American investors would identify with me and be more willing to invest in what I'm doing, but that really hasn't been the case. Most of the people, all the people that have invested in our company have been predominantly white and men. And if you break that down even further, it's been a lot of Jewish men. And so why is that? Why can we peel that back a little bit more? And the risk capital end of it is an important part. Does someone have enough capital where they don't feel like they're living from paycheck to paycheck, or even don't have enough generational wealth where they can leave money for their family members and children? And so you have that access to capital component that is very important. There's the opportunity cost. So for someone graduating from a high caliber school that's accrued a lot of debt, getting that education, leaving a job that pays you several $100,000 a year to start a business where you're not sure whether or not you're going to be able to pay yourself is a huge barrier for a lot of people. And then add the fact that you may have a family to support, that also contributes to it. And then a lot of people talk about the human capital aspect of it. I don't buy into that as much, saying minorities don't have the skill sets needed to run and grow businesses. I think you have to be careful when you get into that aspect of whether or not it's human capital that's truly holding back minority-owned businesses from growing. One of the things that I really start to think, I think there are a lot of soft issues that may underline why there are a lack of minority entrepreneurs in the ecosystem. So what do I mean by soft issues? So confidence is one. Self-doubt, the availability of people around you, whether it's role models, a support system, to help you through the very difficult periods of building a business. And I mentioned earlier at breakfast, there are no shortage of African American men who aspire to be basketball players or singers or sports stars or whatever, because there are people that they can look to and point to as role models. I don't think you have the same thing in other professions. And a while back, there was a concerted effort to try to attract more minorities into finance, and that's had mixed success that Stuart may be able to talk about a little bit more. But there were examples of people, and one of the persons I mentioned is Reginald Lewis, who at one point was the richest African-American man in the country, and that probably influenced a large number of African-Americans to look at finance as a potential option. You have something similar with respect to law. The legal field really made an effort has been making an effort to try to attract more minorities into law, with varying successes there. And there are reasons why, underlying that we're not going to talk about here, but there was an effort to try to get more minorities in law school and get them practicing law. You haven't had a similar attack or approach with respect to entrepreneurship. There aren't as many role models that you can look to say, there's someone who looks like me who has been successful in this space. There aren't as many venture capitalists out there that you can look to and say, here's someone who looks like me. And I think it's a soft topic, but I think that has a great deal of influence as well. So,
Yeah. Stuart, you've obviously talked a lot to, HBS students and many others about this kind of question. What's your sense of where is it really around the soft issues, or are there other things that you'd really point to?
This is such a loaded topic. I think there are so many factors at work here. I think first of all, you have to think, what does the term minority mean? Who are you talking about? Different minority groups have had different experiences. I think it requires a historical analysis on the migrations of various groups, how they got to the U.S., where they've clumped in terms of population, where they live. And then, as education has been made more available, what people have done with that education. But I do think there's something to it. I mean, I think, in the African American community, which I'm most familiar, there's, my parents' generation, as they migrated from the South to the North, there were employment opportunities for them, which led to education opportunities for me. But those employment opportunities were defined largely around being loyal to one company and working there for 20, 30 years. And as long as you did a good job, you had job security. And you hoped that your children would get a good education. And when your children got that education, what you wanted for your children was also job security. It was not taking risks. It was not dropping out of college and pursuing an entrepreneurial venture. So I went to Yale College, and had I dropped out after my freshman year and started Microsoft or Facebook, my parents probably would have had a fit. You know, we did not send you to Yale to drop out and start a business. And I think most of my friends and people I know were in a similar situation. We were very much encouraged to get a good education and get a good job, not to, quote, take a risk, be disruptive, and do something sort of outside the box. And then meanwhile, in the communities, with integration and desegregation, and take a city like Chicago, when Chicago was much more segregated even than it is now, you had thriving black businesses in the South Side serving black markets. As the city opened up and folks moved throughout the city, I think it may have had a negative impact on the ability of those businesses to serve those local markets. And so you had, at the same time, that level of entrepreneurship, the barbershops, the funeral parlors, et cetera. And then with the emergence of the Walmarts and the Amazons and the chains, you know, it put that kind of negative pressure. So depending on what minority group you're talking about, depending on the demographic issues, depending on some of the civic and cultural and city realities, the risk aversion that's inherent in this generational desire for safety and protection for the children. And then I think with the slides that were put up earlier, you know, even if one person is having some economic success, if their extended family has a net worth of $6,000 or $7,000, you know, to your point of do you have the generational wealth? Well, if you define your generation as not just your immediate family, but your cousins and your aunts and uncles, et cetera, sooner or later you're going to bump into this median issue, and you never feel as though you have enough wealth to take enough risk to do something higher to entrepreneurial. I think somewhere, Josh, and all of that, when you stir it all up, is sort of an answer to your question. Don't have specifics around it, but anecdotally, I know I'm right.
Yeah. No, I mean, I guess with all these things, really, disentangling the factors, it's not really possible to run some regression and say this is really the crucial explanation that's out there. Would you agree that the academic literature is pretty much the same place?
Well, the academic literature has looked at, a bunch of issues, right? They're very similar to what was just discussed. Certainly access to capital is kind of the most important factor. So if you look across many different studies, that's the one thing that really comes through for all groups, right? If you look at the underrepresentation among African Americans, it seems to be that access to capital is like the one most important issue. For Latino businesses, similar. That's the number one issue for why there are fewer businesses and less growth. And then if you flip it around and look at how Asian-owned businesses have been very successful in the U.S., that's the number one reason Asian-owned businesses have done very well, is because of this access to capital. So certainly that comes through. Some of these issues about role models, about self-doubt, about confidence, those are much harder to study, certainly for quantitative research that economists tend to do. Those are, very difficult things. The human capital part also is really interesting. If you look at Latino-owned businesses, that's also a very, very important cause, especially if you look at immigrant-owned businesses that are Latino-owned, that the less education, English language ability, those things come through as very important factors. But there's certainly, it's not just one or two explanations. There are many of them. There certainly is a lot more research needed on this, and that's certainly why this panel was, or partly why this panel was created, is to kind of spur more research as more data sets are become available.
So let's dig into this financing issue. And certainly your numbers suggested, Rob, that there was a lot less both equity and debt capital available or taken advantage of or provided to minority entrepreneurs. I mean, Karen, what was your sense sitting at SBA in terms of trying to figure out where the root of that financing issue? Is it something about the financing markets, or how would you explain it?
Well, I think there's a broad issue around access to capital and where the credit gaps exist that really is a reflection of structural issues around the banking market in the U.S. So the good news about the U.S. is that, you know, we at one point had 14,000 community banks. That's down to about 5,000. And traditionally, small business, if you were sort of looking at the Main Street and supplier businesses that use debt as their source of financing, this would be the way you would get it. You would have a bank in your community, they would know you, and that would be part of the underwriting, which is that they would know you. What we found in our work is that, and also at the SBA, is that all kinds of pressures on these banks have created a structural set of issues which causes a credit gap in small dollar loans. And because, you know, many of these businesses, as Rob's data shows, are smaller, they are looking for loans in the $50,000, $100,000, $150,000 range. And that range is just not economical for a bank to do anymore with a personal underwriting. So what's really transformative today is that we've got these disruptors who have entered the business. And at the moment, there's really not enough data to see whether or not this is going to be a positive or a negative for access to capital from minority markets. But we've got a whole new game with the fintech world. And in the fintech world, you've got players who don't have the bricks and mortar overhead. They're using different algorithms to make credit decisions. So they're not just using FICO scores, which are traditionally actually poor predictors. And I believe, although I don't know all the data, that minority entrepreneurs may have more trouble with their credit scores. But they're not really relying on credit scores. So they'll access your cash flow data from your bank and your actual, real-time business receipts, for instance. So if Square is going to make a loan, they will know what your business, if you've got a restaurant, you know, what your receipts have been. The good news is that they're opening up the credit box, they're putting more money out there. The bad news is, and maybe if there were barriers to entry, whether it was, people didn't want to lend to minority-owned businesses, there was some kind of bias, now you've got maybe a better playing field. So this is the good news. The bad news, we're not really sure what the impact's going to be, but it could be that these algorithms discriminate. And we don't know if they're going to be giving fair and impartial access because we don't really know what the algorithms are. But I do know that the fintech providers are very concerned that they will go afoul of some of the of the equal access and opportunity in lending laws in some of their algorithms. And the second issue is that there's not a lot of regulatory oversight of the pricing and the terms in these markets. So like payday lenders, this could take advantage of entrepreneurs who are less sophisticated. So there's opportunity coming on now, I think, in breaking open this access to capital, and there's risk. And you find this whole network of CDFIs and other on-the-ground lenders and activities that serve these underserved markets being a little bit wary, being excited, but at the same time a little bit wary of this new innovation.
Stuart, what do you think about on the equity side in terms of where the real hurdles lie? Because clearly with a lot of these businesses, even with the bank lending, there's going to be a need for equity to sort of turbocharge them.
Yeah, well, I mean, the formula is pretty traditional and not really all that complicated. if you're going to buy or build a business, you need hopefully a combination of debt and equity. You just heard the complications with respect to getting financing from banks. Equity is going to largely come from yourself, your friends and family. It's highly unusual to be able to tap into institutional equity because the filter that you have to fit through requires scale, experience, team, governance. A lot of the pieces have to be in place to fit their objectives, which frankly rarely exist in small companies. And one of the objectives of that institutional equity is not whether you're a minority. So there's no real preference or initiative on their part to seek out minority entrepreneurs. If it happens, it happens. So that's some of the challenges with respect to the equity. Also, the return objectives. I think in order, equity has its own demands. That folks want to put the money out, get more than they put out back, put more out, get more than that back, et cetera. And the desire of the equity is uniquely focused on return. And if you present an opportunity for them to achieve that hurdle, then that's fine. If you have any other objective, unless that's part of their investment mantra, then you're one deviation off of what they're looking for. And so I think that often makes it difficult for entrepreneurs, minority entrepreneurs that represent sort of deviations from what the traditional equity perspective is looking for. And sometimes you'll find it, but I also think it's a generational thing to a certain extent. I just wanted to, when I was talking earlier, I thought about one situation. I was talking about how my parents would have responded had I dropped out of college. The flip side of that is one of the businesses I own, one of my investments, a young guy came into my office. He was 38 years old, and he was Indian and born in India, was our lead programmer for our company. And he came into my office in tears, and he said, "I have to resign." And I said, "Why?" And he said, "Because in my family, my father has said, by the time I'm 40, I have to be an entrepreneur, and I can't work for you." And this is a guy who was making well into six figures. I don't know of a single African American who has ever had that experience that I know of. But I do think there are differences, and part of his opportunity to go start his own company, which I then invested in immediately, was his family was set up to support him if he went into business for himself. And so his father and his uncles, they had pooled their capital together to back him, but he had to resign and he had to go off and he had to start. That was the way he was raised. And so equity is a complicated thing, Josh, and it goes from the institutional to the friends and family. And I'm happy to say he created, we call it a poor man's Salesforce.com. And is doing very well, and I'm an investor in his business, but and he's raising two sons, and he told me that when his sons get to be 38, he's going to have the same conversation.
Facts of life. So, I mean, it is interesting, right, that we often sort of denigrate it as, friends, families, and fools in terms of, that kind of equity financing. But, even when you look at the pool of the vast majority of companies which raise venture financing, they got some initial funding from their network or, friends and so forth to really bring themselves up to the point where they were really ready for prime time in terms of facing the VCs. So again, the issues around wealth disparity clearly, raise their heads.
Yeah, just one more quick thing. When you walk through some of these incubators, just walk through them and take a look at who's sort of hanging around the laptops and sitting around groups and talking about and getting some real valuable experience in their early 20s and who they are, where they're from, how they're funding themselves, how they're paying their rent. Really start to unpack that, and you'll see a lot about some of it really supports some of the slides that we saw earlier about income inequality.
Yeah.
And also to add to that, when you look at how most venture firms operate, yes, there may be public ways to get a deal in front of them. For the most part, they rely on their networks.
Yeah.
And when you look at who runs those firms and what their networks may be, it's fairly obvious to see why funding flows the way it does.
Right.
So
the National Venture Capital Association itself put out a report last month which highlighted the composition of venture capitalists, which was not exactly what you describe as highly diverse. And some of the stuff that we've been doing with the Knight Foundation, which looks at the ownership of investment firms, makes that point in venture capital even more dramatically when you look not at the people who are writing the checks, but the people who are ultimately controlling the firms. It is a very extreme kind of picture in many respects. So let's, this really sort of sets up the question of really policy, right? And there's really sort of two sides of what we might regard as policy. One is the public policy side, but then there's also a set of issues which we might regard as sort of, business policy of what corporations can do. But maybe we should start with the easy stuff, which is the public policy stuff. And Karen, could you maybe talk a little bit about at least looking backwards, since looking forward is still a tad bit uncertain. What have been the sort of main levers to pull, and to the extent that you can share some perspective on what seems to have worked and what's been more challenging, I would be definitely fascinated as well.
Well, I do think, as I said earlier, that government has a real role to play, and this is federal government, but also state and local government. And at the SBA, was sort of a mess when I got there, and we decided to organize around what I used to call 3 C's and a D. That happened to be the grades that my son got his first semester in college. So it was top of mind for me. But the 3 C's that were capital, counseling, and contracting. And the D was disaster operations, which we had a big role in. But the 3 C's are really actually a useful way to think about places that governments can have a big impact on creating access and opportunity, particularly where the market is not working. So we talked about capital, but let me talk about counseling and contracting for a minute. It turns out that having advice and counsel is absolutely critical for small business success, and creating that ecosystem of advisors around a small business, whether it's a Main Street business or in some incubator, a startup business, is really critical. So how do you use a little bit of money to catalyze these kinds of advice and counseling operations? The federal government does a lot with a little. So, for instance, there's 12,000 SCORE representatives, which are volunteered retired entrepreneurs that any small business owner in the U.S. has access to, in person or online, for free. And there are 900 small business development centers, which cost very little for the government, and they are jointly in community colleges and local colleges and universities. And there's 110 women's business centers, and there's minority business centers, there are veteran centers, because there's some sense of affiliation when you are talking to somebody who's also been in your shoes, a veteran who came out and founded a business. You get, there's a certain network that gets created. So it turns out there's a lot of bang for the buck on that. And one thing we found is that foreign countries sent 150 delegations to the U.S. each year to the SBA to copy the capital and the counseling and the contracting programs. And the counseling was one of the most important things that they wanted to figure out how to do in their countries, in the developing world usually. The last piece is contracting, and we can spend a lot of time talking about that. It turns out, I used to say, it is the federal government contracting program is the largest small business program that the United States government runs. It's $100 billion a year of what Mike Porter called oxygen in revenue into the hands of small business owners. And there are particular programs for minority-owned businesses, veteran-owned businesses, and women-owned businesses. And they were not really being executed, and there was a lot of fraud, big businesses pretending to be small businesses. So it took about 2.5 years for us to clean up the fraud and prosecute some folks and sort of set down the line that we weren't going to tolerate that activity. And the program really started to bear fruit. And I think it is now being copied. The UK government came and had a conversation. I went there, and they put in a 25% of the federal contracts have to go to small business, and they made their goal, to my envy, in 2.5 years. So I think it is really a matter of will. And this can be copied at the state level, this can be copied at the city level, and it really makes a difference when you say, we're going to look at local businesses, we're going to look at minority-owned businesses, and we're going to send the contracts that way. It sends a really powerful message, and it doesn't cost anything. In fact, it can save the government money.
Yeah.
Yeah, just to add something to that is, I mean, this is an area where there's a huge disconnect between the academic research and the policy world, especially on the contracting part of it. Is I did some research on this a few years ago, and I was shocked to see, you know, as you mentioned, we're spending $100 billion at the federal level. I'm not sure what the total dollar is at the state, local, you know, county and city level. The similar types of programs that are out there for contracting, how many dollars are spent on it? And I found 5 papers that have looked at this issue. And many of them showed very positive results on increasing minority and female-owned businesses in these kind of local communities. And it shows you like the kind of disconnect that there is in terms of, you know, the amount that's spent on it, the importance for policy, and the lack of kind of, you know, serious evidence that shows, you know, positive effects or negative effects or whatever, or, you know, any effects on this. So it's interesting. It's,
Yeah. I think as we think about policy, I think the best place to start is with the question. It's a very simple question. Why is this important? When you look at the locations that are most starved for jobs, it's underserved communities in urban areas. Who's most likely to start a business in an underserved area, in an urban area? It's someone from a minority group. And so why is this important? It's important because this is a way of creating jobs that can help lift people out of poverty and hopefully help alleviate some of the social issues that we're facing today across urban areas in the country. And so I think about it, I think there's a few things. There's stuff like what the SBA is doing. I think there's tax policy that could be used to incentivize people to start businesses and investments in minority-owned businesses. So I know the New Markets Tax Credit has had some success in spurring investments in these underserved areas. But something to think about is, to what extent would, and I know our tax policy is incredibly complicated and that's an issue on its own, but what if you were to provide tax incentives to investing in these businesses beyond the New Markets Tax Credit? What if carried interest was taxed at a lower level if it was invested through a minority owned investment firm, or if it was invested in a minority owned business? Training programs, like you were talking about, what's the aim of these programs? Is it to teach a skill, or is it to expose people to entrepreneurship, to expose people to investing, people in underrepresented groups? And if so, design the program around what will attract the most people into that. And then the final thing I wanted to talk about is on the procurement and supply chain side. So you've seen growing interest in the private sector in making supply chains more sustainable, fair trade, and a lot of that is driven by, you know, economic rationale. People will say I'm personally invested in this. Yes, that's important, and I think it's a good cause to be behind. But I don't think you would see as many people doing it if it didn't make economic sense. And why does it make economic sense? It's because consumers are asking companies to do this. That's why companies like Warby Parker are being successful. Companies like Tom's Shoes, Ben and Jerry's. There's a longer list. So how can you make including minorities in your supply chain, in your procurement process, economically attractive to businesses? I don't know the answer to that. I know people are trying. So universities have programs where they're trying to encourage departments across the university to hire more minority-run businesses for accounting services, for anything that they would hire an outside firm for. I know there's requirements on pension funds and foundations to invest with minority managers, and you're seeing varying levels of successes there. But I think it's all, as we think prospectively about how we shape policy and actions to try to encourage more entrepreneurs, minority entrepreneurs, and investment in those entrepreneurs. I think those are things that we can be thinking about.
Yeah, so procurement is clearly a big lever, right? And in the sense that it's a lot of money both at the government level and the corporate level in terms of doing this. And it seems, again, not a lot of academic research, but the work that has been done, our, Jean-Noel Barrot and my colleague Ramana Nanda have a paper which looks just at the shift of payment terms in the federal government when they shifted to paying or trying to pay in 15 days and how dramatic effect it seemed to have on the small businesses that were subject to this thing. So it seems like this is a big potential club to use to address some of these issues. Where really are the barriers, though, in terms of using procurement as a tool to try to address some of these issues?
Well, I can jump in. The barriers, I think, come from whether the interests of all the parties are really aligned. To take a step back on the procurement space in this minority supplier universe, I've spent a lot of time in this world. On the corporate side, if you look at most of the websites of the Fortune 100, 200 companies, you'll see a stated desire to do business with MBEs, minority business enterprises, also service-disabled veterans and other groups, women-owned businesses, et cetera. One interesting aside, as this trend has evolved, one of the issues they confronted was how do we know who is a minority and what is a minority-owned company? So what they have done is sort of turn that over to groups like the Minority Business Development Council, who provide certifications to businesses that designate them minority-owned. So they do the work of coming to visit your company, interviewing the management, looking at the books, literally auditing how you were funded to determine, and then you are awarded a certificate that designates you a minority-owned business. And so the Fortune 100 companies aren't doing the work of trying to determine who's minority owned and are you a minority, et cetera. They just say, are you certified or not? And if you're, and that's the only level of scrutiny that they apply. So you'll find companies that are certified as minority business enterprises, and you can't find a minority working there. And you don't know how that happened, but they have their certification. And so that's one issue, but along the way to getting those, and as was said earlier, that happens at the national level, the county level, the city level, the state. So if you want to do business with the city of Chicago and you're a minority, you have to have you have to be certified by the city of Chicago as a minority business enterprise. The national certification does not apply. So it gets a little cumbersome from an administrative standpoint. But one of the other issues as it relates to scale is in order to comply and be certified, you have to be 51% minority owned and demonstrate that. Well, if you also want to attract capital, frequently the capital is, particularly if it's in a private equity or venture capital sense, may require that they have 51% ownership of the company, and their 51% ownership does not qualify as minority capital. So sometimes there's structural impediments, and there are some instances where folks have structured their way around that. But for the most part, you can see traditional companies over the history of this country have grown by bringing in outside equity, diluting that equity, and then getting debt against that equity, and their profits and reinvesting that into the growth of the business. If you have to sit at any level of ownership, be it 51% or what have you, then you can mathematically calculate what the limitation is on the ability to grow that company by bringing in new equity, unless that equity complies. Second thing I'll say, and then I'll be quiet, is it's also inhibited M&A and efficient mergers and acquisitions market among minority-owned businesses, because if the business is sold, if I have a certified minority-owned business and I sell it to Karen, it will lose its designation as a certified minority business. And so whatever business I had that came as a result of that certification, I will lose. So query, what would she then offer me as in proceeds for my company, knowing that she's going to lose that business, right? The certification does not go with the transfer. They certify existing businesses, so she would have to buy the business from me and then go back in and recertify it. And for that period of time, it's not certified. So then the customers, the Fortune 100, 200 companies who are saying we're doing business with certified companies, won't do business with my company while I'm not certified, if you all are following me. And so there are nuances like that that provide complications that sort of that disrupt the normal flow of corporate finance, mergers and acquisitions activity, attracting capital, valuation work that gets done to these businesses. And so those are all things that as minorities we have to spend a lot of time trying to structure our way around. And sometimes we get there and sometimes we don't.
Yeah. I mean, clearly this exit issue is a big one that, sort of pops up in a variety of contexts. We did some stuff with MacArthur Foundation around the community development venture capital funds, and they ran into the same problem. They were funding a business in Duluth, and the natural thing was to sell it into sell the forest products company into Weyerhaeuser, and then, essentially it destroys, the goal, which was to create some local business. And yet, if you're not going to be able to have that exit, and few of these businesses are going to be able to scale to go public, why would a financial investor invest in the first place? So it is a very tricky and complex set of challenges there.
And I will just add quickly that as an investor in these businesses, my first question going in is, how am I going to get a return on my capital? And am I going to be able to recapitalize my way to a return? I don't want to sell the company because, frankly, I want the company to be in business and I want this minority entrepreneur to be in business. But I do need to be able to take profits and cash flow off the table to recoup some of my investment. Well, in order to do that, that might run afoul of either desires on the part of their customers or their partners who want all profits reinvested in the business to grow the business, to achieve scale, grow internationally, hire people, rebrand, all of those types of things. And so there my capital sits trapped inside the business, and I'm unable to get it out, and the company's not able to be sold and won't be public. And for someone in my position, that's not a good position to be. That's sort of the lose, lose, lose spot. The entrepreneur may be fine because their business is growing, but my capital is stuck inside the business and I can't get it back. And so as folks who are the professional investors are looking at this space, that's something they need to have an answer to before they'll write a check.
Coming back, Josh, to your point about corporate players, I really think they are a missing link in the environment. American corporate players have really been hands-off on some of these policy issues. They say that's not our problem, we're global players. And perhaps one of the things that could happen in this next administration is a refocusing on the role of American business to create jobs here in America in a more diverse way. And one of those things could be, maybe I'm just using my imagination too much, but if they took a different view of their supply chain. And one could imagine a view of the supply chain as a more of a partnership. Today, all of the incentives from the stock market and investors is squeeze your suppliers, stretch their payments. And if what you find is that this exacerbates the issues among small and minority-owned businesses when they're trying to get capital, they're trying to grow and do all the other things. But what if there were a real partnership and we took some of the intelligence that we've gathered on financial structures and we use some capital from corporations maybe at this point to create, availability of certain capital levels that had different return objectives that were, and they could be subsidized, they could have tax benefits, and I think we have a lot of policy opportunity out there to create financial structures that have different layers. If you look at the CRA money, I think that is a really interesting
That's the Community Reinvestment Act.
yes, the Community Reinvestment Act, which is what banks have to do in their communities. And right now that money largely goes into real estate because it has a geographic requirement. You have to prove that the money went into a certain community geographically. If you could take a Community Reinvestment Act philosophy for folks, who are going to operate in the U.S., and maybe in exchange for a much lower tax rate as part of the new tax package, you say, okay, we're going to give you tax reform, but you have to have some kind of investment in America's business and entrepreneurs, and that has to be a wide-ranging set of activities that help underserved markets. Maybe we could get layers of capital in that address some of the problems that you just brought up.
Yeah. So what is, beyond the, the certification issue, which clearly is a tricky one, right? And, particularly as one thinks about the, stage 2 and stage 3 as additional money comes in, what are the other barriers that entrepreneurs face as they're trying to, sort of sell into the corporate procurement change? As you alluded to, right, there's a button to click saying we're interested in buying from minority businesses. Where are the other choke points or challenges that are out there?
Well, the other one that you brought up earlier is how do you get growth capital? Mm-hmm. The good news is you got a contract from Walmart or the federal government, and the bad news is you got a contract from Walmart and you don't have the cash to buy the inventory. So this cash mismatch, I think, is a really understudied and underinvestigated area. And the paper that you referred to, Josh, I thought was really telling. And my time in the federal government, we took the payment terms of the entire federal government to small business from 30 days to 15 days. And there was a remarkable moment where we're doing the press announcement, and the White House press corps comes in and said, well, we don't understand. The president said, you just said that you're reducing the payment by, terms by 15 days. Are you going to give any more money? No, we're not. And the White House press asked the president, what good will this do? And I thought, this is a big problem because now the president has to explain cash flow and the balance sheet and the income statement to the White House press corps in a soundbite. And he did. He was able to show why having that extra cash available would fuel the growth of these small businesses. And the paper you referred to that Ramana and Noel did actually proves that. So a 15-day reduction in the payment terms created that much additional fuel for these small businesses. What else can we do to make sure that there's a matching of cash, that we don't have these working capital issues, that you can't grow because you just don't have enough access to the cash because of the mismatch in the terms. And this is one of the reasons the software companies have grown so fast. A lot of them don't have big cash expenditures when they grow, and don't have some of these mismatches in cash. So there's a lot of ways to go around this. New ways have come up in the fintech market where there are many more ways to factor your receivables and many more ways to stretch your payable terms. And if those financial products come in, what is the impact of not having working capital mismatches among small business owners? That would be, I think, a really interesting problem to look at, and I think would provide an unexpectedly powerful result.
I mean, this kind of goes back to this sort of broader research on all the different types of capital access that are being used. And some of the recent work that I've been working on, we looked at each type of capital. So debt, equity, where those sources were coming from, if they were from friends, families, and fools, as Josh mentioned, or from banks, or from whatever source it was. And we found that the minority-owned businesses were lacking in every category. We thought what we would uncover looking at these very detailed data is that there might be some substitution. They're less likely to get bank loans. There's been a lot of research on that, right? That minority firms face a lot of discrimination and other barriers in the bank lending market. But we didn't find another area where they could substitute out on that. And so it's interesting what you're suggesting is maybe there is one, it's just that we haven't really gotten there yet, right?
Have you seen certain companies that you've invested in this or advised this kind of growth choke point in terms of the access to capital to fund, the very unglamorous stuff of working capital?
Absolutely, I've seen it, and there's not a sign. I wish I could draw a graph and say when you get to this point, that's where you're going to run into barriers. I think it's different based on the business and based on the industry, and so the face that the company presents can be different from one sector to another. So it's absolutely barriers. There's two words that this is not very non-academic. One is fit, and the other is comfort. And I think this whole topic that we're talking about today falls into this incredibly subjective area of what causes someone to decide someone else is worthy of investment. And a lot of it comes down to fit. Is this person a fit? And do I feel comfortable? Do I feel comfortable with this person? Do they make me comfortable? And if I had to put a word on it, Josh, that's the word I would put. When I see the process, there's no other empirical way to demonstrate. It's not based on credit stats, performance, growth, where the company is in the growth cycle, the sector they've chosen to be in, but a lot of it has to do with the clubbishness nature of the process and whether folks feel comfortable. Does this company remind me of another company? Does this entrepreneur remind me of another entrepreneur? Have I had success with someone that looks, acts, talks like him? I think there's two people who I think have been somewhat lightning rods on this issue over the last 20, 30 years. The first one causes corporate America to roll their collective eyes, but that's Reverend Jesse Jackson. I think he has brought and keeps bringing to the table an aspect of, I think, what Karen was alluding to, but that's one of the missing links, and that is, if we as minorities are such consumers and we have such force in our consumption, why aren't we leveraging that to demand more participation throughout the process from either on the policy side or corporate side? And no corporation wants to see Reverend Jackson show up with his pickets outside of their company, and so they will begrudgingly often yield to that. But it is still a good point. When you look at the percentage of African Americans that use Twitter, for example, or go to movies or eat at McDonald's, their power, I think, is not understood in that community. The second person I would say is Magic Johnson. Magic Johnson for decades has been making this argument that cities, there are urban emerging markets that are right here. You don't have to go overseas. You just have to open up the other half of some of these cities where people speak English, they use dollars, and they are consumers. And if you go to the concierge at this hotel and get a map of Chicago, it will probably be cut off somewhere around Hyde Park, if not Roosevelt. But there's still another third of the city that somehow gets cut off. If you go to New York City and ask for a map of the city, it used to get cut off at the top of Central Park. Now they'll add a little bit of Harlem, but then it's cut off above that. Well, what Magic has said is there are people living there who have dollars, will spend dollars, and put dollars into the community. And so if you look at the highest revenue generating Starbucks in Chicago, it's in that neighborhood on the south side. The movie theaters are in African American neighborhoods because they're so underserved and underrepresented that the markets there are huge and misunderstood. So I think the equity and investing mindset needs to wrap its mind around a different way of doing density surveys and financial models that calculate attractiveness in certain markets that where reality is belying some of their statistics.
Yeah. That, I mean, I think, where there's been a big literature on, behavioral finance in the academic side, which is mostly focused on public markets and showing that people don't want to, sell their losers and this, that, and the other. But it seems that our private investment friends, as much as they like to think of themselves as these paragons of rational thought and dispassionate judgment, have all the same kind of biases running around. I mean, my colleague Paul Gompers has a paper with some co-authors which looked at, venture capitalists and showed that, Indian venture capitalists were far more likely to invest in Indian American venture capitalists were far more likely to invest in Indian entrepreneurs, and Jewish venture capitalists and Jewish entrepreneurs and so forth. But when you looked at that, what he called the price of friendship, it seemed that they were in many senses lowering the bar. They felt comfortable, and then they were actually lowering the bar, and the deals actually ended up doing worse, which suggests that the flip side of that is that people who are less familiar, the bar is higher, and there's probably a lot of good things that aren't getting, potentially aren't getting funded.
That's interesting. That's really interesting.
Yeah, so it's definitely some, definitely some food for thought there in terms of how this, as easy as it is to say procurement can address these things, what are really the barriers to this?
So one of the opportunities, I think, to address some of these barriers are building these ecosystems. And in the high-end entrepreneurship area, I think one of the interesting evolutions are these accelerators and communities. So we know that if you have an innovation ecosystem and it involves entrepreneurs and venture capitalists and maybe universities and research centers, that you tend to be able to generate, more entrepreneurial activity, more company formation, more growth. And one of the questions is, how do you extend those activities to form communities where women-owned businesses or minority-owned businesses have incubators in their sectors or in their geographies, and those seem to be working, although once again, there's not a lot of data and there's not a lot of research yet at the moment. And I think as we see more of this activity, it would be useful to know what's successful, what works, what can we measure, and how can we then, sort of double down on this activity. It doesn't create, it's not very expensive, and it creates a lot of spillover benefits, I think.
Yeah. Another area, and I'd be interested, Robert, to hear from you or anyone in the audience that may be focusing on this, but the opportunity cost, we've talked about this as a potential barrier. And traditionally, you think about that in terms of what am I giving up? But I'd be interested in hearing if there's any research or anyone that's really thinking about real and perceived cost of failure and what effect that may have on someone's willingness to make that leap and start a business. So if you are highly educated and have a good job, but then you think that if you start a business and you fail, it's going to shut off, other traditional employment opportunities. What impact does that have on your willingness to start a business? Or let's say you're not as highly educated and you don't have kind of the traditional trappings of that we would consider being successful. What cost will that failure have on your future career prospects, on the ability for you to continue to provide for your family? I don't know if you've seen any work or anyone in the audience who's seen work on that. It'd be interesting.
Yeah, I certainly haven't seen research on the kind of racial or ethnic part of it, but certainly kind of one story you hear in Silicon Valley is that failure as an entrepreneur often creates great job opportunities for you, right? Is that a lot of firms look at it as, wow, you tried it, you failed, you learned an incredible amount. Hey, we'll hire you now because you have that kind of experience. But yeah, I mean, I'm not sure it translates over to a lot of other types of businesses. But.
So the reason I ask is because, and I know you guys probably have great comments, but someone I was talking to who educated at Brown for undergrad, Stanford for a graduate business school, worked at Facebook, worked at Google, and their concern was that if they started a business and failed, they would have essentially foreclosed opportunities at those other companies. And they felt like because of their race, their failure was going to be viewed differently than a peer's failure who had similar educational background but was white. And so I don't know if that's real or not.
Well, I think the fear is real. The concern is real. I've heard this for decades. You know, there was a wave of minority-led private equity firms about 15 years ago when these limited partner institutions realized that they needed to do more business with minority-led private equity firms. And so there was a whole wave of firms that got, and many of them were able to raise Fund 1 and never got to Fund 2 because Fund 1 underperformed the expectations of the limited partners. And a lot of the people that came up out of that industry today would say their peers who also underperformed got funded to Fund 2, 3, 4, and it was articulated, to your point, as now they're battle tested. You know, they've got the requisite scars, they've been through the battles, they know what failure looks like, so now they're qualified, and they're like, okay, for me, I failed, and for them, they're qualified, and how does that work? You know, so I don't know if there's research, but I can tell you the fear of that is real. You know, that minorities often feel like they can't have that failure because it will be stuck to them in a way that they can't either repackage or reposition, and it will just continue to kind of weigh them down.
So it introduces a kind of potential risk aversion or something along those lines.
Absolutely, makes them less willing to take that chance, and as your friend was indicating.
I guess one point which we dropped, but which I think is worth emphasizing, is there's not a great deal of good literature on it, at least based on my perusal on my iPhone, which is always the best avenue for doing research reviews. But you know, certainly it seems that the limited amount of survey, the work that has been done around, you know, these sort of new entrepreneurial finance of incubators, accelerators, launch labs, and so forth, suggests, as I think was sort of implicit in your comments, Stuart, that it tends to be a pretty, you know, pretty non-diverse environment, I think,
Well,
to put it
yeah, I
kindly.
mean, I live here in Chicago, so I happen to know a number of them here and bounce around in that community. I can't tell you how many friends I have who are Caucasian, who almost, you know, it's like the new badge of honor. You know, I've got this 22-year-old son, and I'm funding him while he's sitting up there in this building with 3 of his friends trying to get this business off the ground, and this is what it's costing me in rent and transportation and mortgage, et cetera. Ha, 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 you know, and I always ask them, well, how diverse is it? Let me go see them. Let me go walk around. I rarely see African Americans or Latinos. And when I do, I ask them, and they're like, my parents hate me. You know, they think it's akin to I've run away from home and I've joined a cult. You know, and I contrast that with my employee who was really shoved out to become an entrepreneur. And I really think about what the difference is. As Karen was saying earlier, this incubation and mentorship and sense of community, I think it's the single most important contributor to the ultimate success of these folks, is being able to have broader networks that they can tap into, affinity groups, people that look and sound and talk like them, that they can bounce ideas off and touch base. And whether that comes from whether policy creates that, whether the government creates that, whether companies create it, or whether they do it on their own, I really think that's critical to building sort of their individual sort of self-worth, if you will, while they go through this process. And we're just underrepresented in that. So I think wherever we can get that, I think that's the first step, in my opinion, to creating that kind of an ecosystem.
You know, those of you who study non-U.S. markets might also have some insights to bring to this, because there are a lot of environments which are not like the U.S. where failure is really a problem. and even developed countries, the UK, Germany, but nonetheless, they want to inspire more entrepreneurs. They want to cultivate the innovation part of their economic growth. And so they are experimenting with these kinds of incubators. And if we find out what works in sort of other risk-adverse environments, and also in developing countries, can we actually bring that back to underserved areas, to inner cities? Because there's, I think there's a real core of interest in creating these activities in the cities today, not great understanding of the templates about how to make it work. And we've got a lot more creative options, I think, that we're going to start to exercise in the local and city communities. As I suggested before, there are different players, particularly the private sector, that in this next administration are going to need to step forward with capital, with support, with training, and they're willing to do so because they do have an interest in the community. So how can these folks be engaged successfully around outcomes that they think will result in the positive, a positive influence in their communities?
Yeah, I mean, I loved the one example that I thought was most creative along these lines was Singapore government did this for a number of years, where they created this Phoenix Award, where the idea was the Prime Minister would give an award to the entrepreneur who was the most meritorious failure of a startup business. And the idea was that somehow it would destigmatize entrepreneurial failure by getting your award and your photo with the PM and all that kind of stuff, which was at least funky and creative, if nothing else.
Was it successful?
Well, it's hard to say, but at least it was a try at doing something interesting. I think we can entertain ourselves for the remaining time without much difficulty, but I would propose that we throw it open for a few questions and see what things people want to talk about. If everyone's bashful, I've got another 14 issues that I can get into, but I would much rather hear things that people would like us to talk about. And either you can come up to the microphone and ask your question there, or if you just want to shout it out, I'll repeat it so that it's preserved for posterity, and we'll take it from there.
Hi, Derek Price. A couple of quick questions. One for Karen. The SBA, I'm in sort of fintech. Well, my specialty is community economics, and that's the problem. I used to tell in Ivy League and Big Ten school, they don't teach community economics. There is no black economics community course or no community economics. So what I would like to propose, and it goes with Stuart's problem, our community problem, is they used to have a MESBIC at the SBA. It was like the SBA has a small business investment program. It's really for venture capitals. Mm-hmm. And that's how the Apple got their money, and all these big fortune guys, they think they're small in the basement, but they went to that, in which the SBA gives them $10 million. I think it's $10 million right now, and they can leverage that with SBA funds. But there was one called a minority MESBIC, which it had a lower level. You can come in, I think, with $5 million. SBA stopped that. So if we could bring that back and lower that threshold, like $2 to $3 million, they can invest in minority businesses. Bring that back engaged. Now I can get Stuart or anyone to buy that certificate as an investment to come back for small businesses. Second, the Stuart mentioned, you got to understand, when you grew up and I grew up, when you walked out the neighborhood, there was a black-owned grocery store, there was a black-owned butcher market, there was a black-owned laundromat, there was a black-owned. So the community had dollars that was flowing in the community. So right now, if you all go back, when you go back home, if you drive through the black community, all of those businesses are controlled by outside ethnic groups. So no matter how much we spend in the community, if I gave everybody $50,000, at the end of the day, the community would never thrive because the money, it just leaks out. So we got two things fundamentals. We need black businesses back in the community because the business in the community, the money doesn't flow, it goes out to the B of A or whatever. And second, we need a policy like you did, that 15 days cash flow. Now, I'm in fintech. Here's what the problem is. Those lenders, alternative lendings, those guys came out the payday industry. So that's what's surviving on the south side. They actually get a loan in 24 hours in their account, but the interest rate is 30%. A bank is too much. Now, I'm glad you brought up about the secondary. Here's my question. Nike was right down the street. They put it on the black south side. Highest store in their market. And they thought it was a loser. Same with Home Depot. Went back on the black south side. Highest grocery store in their network. So there's money in the black community. We don't have the entrepreneurship. The accelerators, that I've seen them all in the country, are coming to be country clubs for if you went to the schools or whatever. So what we need to do is, I think you need to do an academia. I need to do a study, or if it's possible, get with us. We need a new policy, a new paradigm, just for what I saw dynamic or distressed communities. I don't think we could bring that type of model that you've got back to where we are. So I think Kaufman did some research on how much dollar amount that they need, 180. But I just need I think you need to think out of the box and tell me, how do you get down to that model versus you bringing in the VC model and those models that just won't work on this marketplace?
It's a great set of questions, and I think I'd like to break it into a couple pieces. So let's start with the one around, sort of the history of government promotion of minority venture capital. Right? We had the MESBICs, and then it transformed into the SBICs, the Specialized Small Business Investment Companies, which may still be in existence somewhere, maybe.
Yeah.
So what are the sort of lessons learned from that experience? Again, it's sort of been a topic which hasn't had a lot of research, but I've got at least a few guesses, but I'd be interested in your perspectives around it.
Well, I'll take your first one about the SBIC program. And for those of you who are not familiar, to me, this is one of the hidden gems that exists in the government. There is a program at the SBA which is designed to foster many venture capital companies throughout the U.S. in places that are underserved. So 70% of the venture capital goes to 3 states, California, Massachusetts, New York, so there's a lot of places where there are great entrepreneurs and there's no equity capital. This includes many communities that are underserved. So there are now about 300 of these SBIC funded, and the program was really underutilized because it was administratively impossible to deal with. So we were able to fix that, and the funding for the SBIC program is $4 billion a year in investment capital that the government will put in a debenture, in a government-backed debenture. $4 billion a year makes the government one of the biggest limited partners in the country. The cost to taxpayers of that $4 billion is zero. And the reason is that the structure that was developed, and this was developed in 1958, the structure is that you as an investor go out and raise some money. You can raise $2 million, you can raise $10 million, you can raise usually up to $150 million. The SBA will match or double that in a debenture, a government-backed security which we sell in the open market. So the government doesn't even have to come up with the cash. It's a government-backed security, gets sold. And the investor gets their $50 million they raised plus 100 that the government gave them. So now you're investing 150, but you get all the upside. What does the government get? The government gets, and you invested in growing businesses. So this puts lots more capital into Iowa and South Carolina and entrepreneurs in underserved communities. And it works now extremely well. It requires, it's almost a perfect, Trump administration policy, because it's a public-private partnership where the private sector is making the investment decision, not the government. The government is not picking the winners and losers, but the government is just giving you more capital. The investor's happy because they get 300 to 600 basis points increased return in a top quartile fund because they have more money. And the taxpayer is happy because the taxpayer has a debenture. They get their money back first. As a result, because of the fees, there's no losses, and the whole program costs nothing to taxpayers. I think this model is actually very appropriate for other uses. It could be used in infrastructure projects, for instance. It could be used in local communities, for state-funded projects, for cities. And so I think it's a really interesting example of how to drive activity that's needed into an underserved community at little cost to taxpayers, with a public-private partnership where the private sector is bringing their expertise to create, more positive results.
Yeah. I mean, I guess the one thing that is worth emphasizing, though, is the need to design it in a way that doesn't make it so painful, right? That I think when you looked at the experience of, for instance, the MESBIC program in the earlier days, right, it was done in a way that ended up being that anyone who could raise money from other sources would go to those other sources, because it was just so arcanely structured and so bureaucratic. And in fact, in a lot of ways, the rules were counterproductive in terms of creating all these disalignment between the government as a limited partner and what traditional investors would have
Josh,
liked.
it's totally true, and I think this is one of the issues with government, which is that people are very risk adverse. They don't want to create the opportunity for fraud or malfeasance, and they create so many barriers, and it's so technologically backward that it's just too painful to deal with.
Yeah. So in a way, a lot of the sort of devil is in details in terms of how these things are structured. I think the other question I wanted to just sort of raise that was inspired by that one is, in a way, Karen, you alluded early on to this sort of finding by John Haldenwanger and Javi Miranda and Ron Jarman around this sort of declining rate of new firm formation in the United States. And the point they've made is that, if you look from the 1960s onward, there seems to be this decline in terms of the rate of new firm formation. And, anecdotally, we think about the sort of small town which had, 10 small businesses on Main Street, and then, Walmart comes out in the suburbs, and it sucks a lot of, it closes down a lot of businesses, and you can make the case, well, it's much more efficient Walmart on one hand, but on the other hand, there seems to be some real costs associated with it. And I think what the question, pointed out is that, this has also sort of manifested itself in, minority communities as well, right? Where the sort of scaling up the creation of big box and the economies of IT, logistics, and so forth have meant that, that same kind of hollowing out of, small entrepreneurship has taken place in a lot of inner cities as well. Is there a way to, is that just something we have to accept, or is there a way to make, lemonade out of the lemons?
Well, I think it's a really good point, and you raised a really good point in your question. The butchers and the store owners and all of these folks that were in these inner cities, the fact of the matter is, if they did well, the funeral home directors, if they did well, and we went to school with their children, and when they did well and their children were able to afford a good education, none of those children wanted to go back and run the butcher shop or the funeral parlor. They wanted to go to McKinsey or Morgan Stanley or IBM, and they didn't want to live on 79th Street. They wanted to live downtown. And so who's left on 79th Street and who's left and what happens to the butcher shop. So it's, some of this is understandable, some of it's generational, some of it has sort of almost like an immigrant kind of a generational pattern to it. But I think to your point, Josh, about the entrepreneurs and what's happened, I mean, I've probably seen on average 150 business plans a year for 10 years from folks. And many of these are people who are really desirous and have really innovative ideas. But then there's these big shops out there, whether you're a clothing designer, a musician, you can try and design the jeans yourself, try and get warehousing, right? Try and mass produce them. Or Target or the Gap will come and say, we like your designs, come and work for us. Your design will get blasted through our system and you'll be an employee of the Gap, right? And then they come to me and they say, we want you to fund our business because we don't want to go down that road, but I now need to have a warehouse and I need to be able to supply Target or the Gap by a month from now jeans to all their stores. And then I say to them, in order to write the check big enough for you to do that, I'm now going to own 90% of your company, right? Not you. And that usually ends that conversation. But that's oftentimes the predicament that these folks, as these big companies, you talked about Walmart, look at the iPhone, look at the number of businesses that this has put out of business, industries that have been changed, from the travel agencies to the camera to watches, to everything that we tune to pick up our phone for first. And a lot of those were mom and pop businesses up and down the street that just don't exist anymore. So people now feel like it's I call it the Shark Tank of America. In order to move the needle, you just have to sort of rack your brain and come up with some idea that's so revolutionary and so creative that sort of bursts through that hasn't been done before. I think some of the stuff that Karen was talking about earlier, I think is really the key. It's some of the blocking and tackling, B2B, supplier-based corporate partnerships, thinking of with your supply base as a partner as opposed to someone you should squeeze. I think that path, the resistance there is less than trying to think of another app that's going to change the world and make you rich, So anyway, just my thoughts on entrepreneurship. Sorry for rambling, Josh.
No, it's great.
I just want to say something quickly on the last point you raised about needing a different, I don't know if it was a different form of capital or not high finance, but something more suited for the community. Different model. I think there's, and maybe it's semantics, but the term venture capital has come to mean an investment in a highly scalable technology business. And I don't think that's what the term venture capital should mean. I think venture capital is an investment in an early stage business of any kind, and it should have the ability to scale to earn that investor a return, but it doesn't have to be a technology business.
Yeah, that, in a way, it seems like a lot of these businesses are probably going to be, that are in Stuart's sweet spot are really more targets for growth equity in terms of saying we aren't going to, we're not going for 100x, we just want a 40% IRR or something like that.
And right now what's happening is the people that are raising venture capital are saying we're going to get you 100,000x returns on the capital you're investing with us, and then what's the classification for businesses like what Stuart's investing in? Is that not venture capital if it's early stage? How do you? So I think some of it is around how we define that term and how we evaluate investors within that classification.
Yeah, it's interesting. Yeah.
Hi, my name is Emily Lerner. I'm with Third Way. Last fall, I did a policy paper about bank lending to small business, and I ran into a major data collection problem. We don't even track what a small business loan is. We just, have a rule of thumb if it's less than $1 million, and I know this came up in your HBS paper, Karen. I also wanted to use this opportunity to maybe test out a thesis that I have looking at venture capital specifically, but this could probably go for bank lending as well. I think about women and minority entrepreneurs as having like plate appearances and batting averages when it comes to venture capital, to use like a baseball analogy. Women and black entrepreneurs are less likely to come up to the plate But when they pitch to venture capital, women are more likely than men to get the full funding ask. Black entrepreneurs are less likely than white entrepreneurs to get their full funding ask. So Josh brought up this point about public policy versus business policy. Whose job is it to fix the plate appearances? Whose job is it to fix the batting averages? Where do we go from here?
All right, data point, Karen,
I'll take the data.
is squarely
Just
in your
like-
plate to start off with, at least.
I'm so worked up about this issue, I can't even breathe, so I'm delighted that you brought it up. In this country, we do not collect data on loan originations. So, at all. So we don't know what the state of access to capital is, particularly for small businesses. And it is like asking people to fly blind on major economic policy. I had this conversation with at the Bank of England and with those in the UK and the Treasury, and they just couldn't believe it. They're horrified to know that we don't collect this data. So I actually put a provision in Dodd-Frank called Section 1071 that requires the collection of this data plus collection of data about funding of minority-owned businesses and women-owned businesses, and that is the law, but it has not been implemented because the CFPB has had a whole agenda of consumer protections, and right now the CFPB and Dodd-Frank are going to be revised in the new administration, so the likelihood that we will get this data is really uncertain. For understanding all of these issues about access to capital, therefore, we don't have that kind of data. We do have some new sources that are coming out. PayNet and others, SageWorks, are starting to make certain data sets available. So I think there's really good opportunity to use those data sets, and those providers are very eager to provide them to academics at little or no charge. So I think it's a good opportunity to kind of get in quickly and get those data sets. But the government at the moment doesn't collect it and doesn't have a plan to collect it.
Rob, how did you do the numbers that you put up there? How did you try to get at some of those issues?
So that's all through the Kaufman Firm Survey, which is you've got a sample of 4,000 firms where they're each asked about their investments of capital. So it's not in the scale that Karen is hoping that the federal government or the government agencies will put together. So that's a disadvantage. But there is a lot of detail. I mean, there is an extensive number of questions about the type of financial capital for these businesses.
Yeah, but certainly it seems like if you think about where the most exciting opportunity lies, I guess I would argue it, as you say, it probably lies in the private sector, big data, people who are, clearly in the course of business gathering a lot of stuff.
Right, and also with some of the new folks who are, like Cabbage and others who are gathering a lot of data for the algorithms, there's a lot of interesting analysis going on inside those firms that they may or may not be willing to share with a researcher.
Can we spend a second on the question of the second question around plate appearances, and saying, how do you, if we think one of the problems is just simply getting people in front of financing providers, what are really the most direct steps to increase the number of plate appearances by minority entrepreneurs?
Yeah, I kind of alluded to this earlier, something that universities are starting to do with their in their procurement space. So, and just to explain at a high level, they have an event where minority investment managers get to meet people that run the university's endowment, and then over the course of a day, 5 of them are chosen to pitch to those endowment managers. And so the managers are seeing folks that they wouldn't otherwise see. I don't have any statistics around what level of investment have gone into those managers that they've met through this program, but it's something to get them in front of managers that they wouldn't otherwise see. So something similar, if firms took a proactive role in trying to do something like that and saying, we're going to have days where we're going to see female entrepreneurs or we're going to see minority entrepreneurs, and get to meet people that we wouldn't typically run into through our social circles and our traditional deal sourcing networks. That could be a great way to increase the number of people that they're seeing stepping up to the plate. I'm sure there are a lot of people who would step up to organize and coordinate things like that. But I think that's one way to try to get more appearances at the plate.
Yeah. No, it's an interesting set of issues, right? Because ultimately, when you think about saying whose money is it, right? Certainly, many of the crucial investors have been public pensions and so forth with a very diverse membership. And it seems that it would be natural that it would somehow flow through, but certainly, with the exception of a few programs where they've targeted minority managers, there's not been a lot of activity there. Even many of the programs that have been done have been sort of cast more broadly as emerging managers, which is sort of a fuzzy term that can include a lot of people as emerging. And it's just interesting to think about whether, perhaps more creativity could go into some of these issues, both at the limited partner level, at the level of the pension funds, as well as at the fund managers themselves.
I'm on the board of directors of 3 public companies, each of which are greater than $1 billion in market cap, and I think a lot of pressure can be applied at that level too. I mean, I think, I know I agitate regularly in the boardroom, and if you're on the board of a company, the management will listen and will respond. And I think to insist at that level that we are provided the at-bats for supplier firms to pitch and partner with the companies can help. But I also think inside these pension funds, which are governed by very diverse bodies as well, I think they can apply that pressure because the ultimate universe that they're representing is incredibly diverse, and yet no one is really speaking for that group with respect to making these kinds of demands. Beyond that, I think it's dangerous to go, in my opinion, too far, because those of us that are in the deal business, we like to think of it as an art, and we like to control it, and we like to rely on our own intellect and our own preferences and our secret sauces. And unfortunately, though, when you roll all that up, you get a lot of bias, and you get a lot of preference, and you get a lot of fit and comfort issues, as I said earlier, and it starts to break down around people doing business with people who look like them and they feel comfortable with. And it's how do you structure your way around putting pressure on that is a really, really hard thing to do. And I don't know that I have the answer.
Yeah. But in a lot of ways, it also does come back down to the data issue, right? That, thinking about the question of diversely owned investment managers and what, we've just discovered as you look at sector after sector, even mutual fund managers where you think would be relatively easy, but certainly as you get into hedge funds, private equity, real estate, it gets even more and more challenging to really even just get the basic demographics of how many managers are there out there, what share of them are diversely owned, what has their performance been, and so forth. Even just getting the facts out would seem to be the first step for having a conversation around this and potentially evaluating some policies.
Yeah, I'm just passionate around just priming the pump, Josh. I think that's an interesting process to go through to sort of scan to see who's out there who's already qualified. I like to spend my own personal time getting more people into the pipeline, as opposed to sort of trying to kick over rocks and find that up till now unseen and unknown manager that might be qualified in accordance with some filter that's way too narrow. I think those folks are largely known, and many of them are doing quite well. It's the people who are not there that I'm more worried about than, frankly, the people who are.
I think that's right. But I want to put in a plug for Josh's approach of counting and uncovering the data, because what gets measured gets done. And the first step to measuring is, finding out that there's a gap and a problem and sort of quantifying the problem. Once you quantify the problem, then you can say, well, how many new folks do we have to get primed up to get through the funnel to make a difference? And it turns out that once you really quantify it, then you can say, okay, this is a problem we can solve. We just need this much priming because, and 1 in 20 will make it through. And then all of a sudden, you've got a construct where you can say, well, we only have 3,000 deals that get done in venture capital a year. So how many thousand deals do you have to have? It's some manageable number of the hundreds of deals that you have to have done by women-owned businesses or minority-owned businesses to actually move the needle. And then you just start counting whether you're making progress or not. But if you don't have the initial transparent view, you cannot start that, reverse engineering success that way.
I mean, so you coming back to this priming the pump, right? So the data that I showed earlier, if you look at the adult population of African Americans in the U.S., only 2.7% own a business. So I mean, there's such a structure of barriers to even begin. We still have to overcome that part of it, right?
Yeah.
To get those at-bats that we're talking about.
I do think that actually the high-end entrepreneurship problem is easier to solve because it's smaller numbers than the issue of Main Street entrepreneurship. And I think a really interesting point was raised here about community. What happened to sort of the Main Street small business in a community, and that as a path to the middle class. One of my hypotheses, which we don't really have any way to really investigate, is that entrepreneurship has been a traditional path to the middle class, that some of the findings that we are seeing on the decline in the rate of entrepreneurship have contributed to this inequality, this sort of shrinking or pressure on the middle class, and that has contributed along with the exporting of jobs and overseas of these middle class jobs. If we understood that better, I think we would be more proactive about creating more pathways to entrepreneurship in all kinds of sectors and all kinds of underserved communities.
Can I just say
one
more quick comment, Josh?
Yeah.
Just to the priming of the pump, I gave a keynote address to the NSBE, the National Society of Black Engineers, and this is a group of student-run students, Black African Americans in the top 50 schools across the country who are all majoring in engineering. So it's a STEM-loaded population. I don't know why I was speaking to them, but they wanted me to speak to them. But anyway, I just want to share with you, I asked them a ton of questions because there were 700 of them, and so, and they were all between 19 and 22 years old. And I'm generalizing, here's what they would like for their career path to include. They would like to go to college, get a job at a company, big company, pay down their student loans, get out from underneath their parents, work there for 5 to 10 years, and then do something entrepreneurial and somewhat risky. That's their path. And everyone, so if you just break that down, are there employers out there willing to hire them today? When they hire them, are they going to give them the level of responsibility to achieve the skills and develop the skills they want? Will they have the risk appetite and willingness after they've made some money and bought a few things to leave and go off on their own? And when they do, will there be a receptive market out there to fund them? But what I am saying is that the front end of the funnel exists. There are people who are willing to start going down that pipeline. The rest of it, I think, is up to us to decide whether we're going to help receive them and broaden the funnel and nurture them as they go through that process.
All right, well, the appointed time has come. I just want to end. We started by saying these are complicated issues, and I don't think we've quite solved them, but hopefully we've left you with 3 things, one of which is an appreciation for some of the trade-offs and the ambiguities here. Secondly, a sense that there's some really great research questions, and finally, even though I don't think the data is by any means perfect, it is practical to dig into and explore some of these issues. So I hope you found the discussion to be interesting, and thanks to the panelists for sharing their thoughts, as well as to all of you for getting up early and making it through the cold to get here. So thanks.